In 1910, 6 of the most powerful men in American finance boarded a private train car under fake names, telling reporters and even their own families they were going duck hunting. They traveled at night, addressed each other only by first names to keep the staff from learning their real identities, and disembarked at a remote, members-only resort off the coast of Georgia called Jekyll Island. For 9 days, in near total secrecy, this small group, representing an estimated 1/4 of the entire world's wealth at the time, quietly drafted the blueprint for what would become the single most powerful economic institution on Earth. They weren't hunting ducks. They were designing America's central bank. And what's genuinely strange, genuinely worth sitting with, is that the institution they built still doesn't officially call itself a bank in any conventional sense, isn't fully owned by the government, and yet can move trillions of dollars through the global economy with a single sentence spoken at a press conference. Its name is the Federal Reserve, and despite being one of the most consequential institutions in the modern world, most Americans, including many who use dollars every single day of their lives, have almost no idea how it actually works, who actually controls it, or how it came to exist in the first place. Welcome to Economy Rewind History. This is the strange, secretive, and quietly extraordinary story of the Federal Reserve. To understand why 6 of the wealthiest men in America felt the need to sneak onto a train under false names just to design a banking system, you first have to understand the chaos that came before it. Because the Federal Reserve wasn't created out of ideological ambition. It was created out of genuine panic. Throughout the late 1800s and into the early 1900s, the United States experienced a brutal recurring cycle of financial crises. In 1873, in 1893, and most dramatically in the Panic of 1907. That crisis began when a failed attempt to corner the market on a copper mining company's stock spiraled into a nationwide wave of bank runs, stock market collapses, and the failure of numerous trust companies. What made 1907 especially alarming wasn't just its severity, it was who ultimately stopped it. Not the United States government, which had no central mechanism for injecting emergency liquidity into a collapsing banking system, but a single private individual, the financier J.P. Morgan. Morgan personally gathered the country's leading bankers into his own private library in New York City, and through sheer personal authority, strong-armed them into pledging their own capital to backstop the failing banks and halt the panic. This should sound genuinely alarming from a modern vantage point. The stability of the entire American financial system in 1907 depended on the goodwill and negotiating skill of one 70-year-old private banker, meeting in his personal library because no public institution existed capable of performing that role. Congress was deeply unsettled by how close the country had come to catastrophe, and even more unsettled by how dependent the rescue had been on one man's private discretion. So in 1908, it established the National Monetary Commission, tasked with studying the problem and recommending a permanent solution. Its chairman was Senator Nelson Aldrich, a powerful Rhode Island Republican with deep personal and family ties to the world of high finance. And it was Aldrich who quietly organized the secretive Jekyll Island expedition in November of 1910. The men who joined Aldrich on that trip represented an almost unbelievable concentration of financial power for a single train car. Alongside Aldrich sat Abraham Piatt Andrew, an assistant secretary of the U.S. Treasury, Frank Vanderlip, president of National City Bank, at the time the largest bank in the country and the direct institutional ancestor of what is now Citibank. Henry Davison, a senior partner at J.P. Morgan and Company, Charles Norton, president of the First National Bank of New York, Benjamin Strong, another Morgan associate who would later become the first head of the Federal Reserve Bank of New York, and Paul Warburg, a German-born investment banker at Kuhn, Loeb and Company, who had studied European central banking systems extensively and is widely credited by historians as the intellectual architect behind much of the eventual plan's technical structure. Over roughly 9 days at the Jekyll Island Club, this small group drafted what became known as the Aldrich Plan, a detailed blueprint for a new American central banking system designed specifically to prevent future panics like 1907. The plan proposed creating a mechanism for elastic currency, the ability to expand and contract the money supply in response to real economic conditions. It also called for reserve requirements and an emergency lending facility capable of backstopping struggling banks, without requiring a repeat performance of J.P. Morgan personally rescuing the entire system from his private library. Here's where the story gets genuinely important to understand carefully, because it's frequently either exaggerated into outright conspiracy or dismissed too casually as irrelevant trivia, and neither extreme captures what actually happened. The secrecy surrounding Jekyll Island was real, extensively documented by participants themselves in later interviews and memoirs, including Frank Vanderlip, who wrote decades later that he had never in his life felt so keenly the sense of being surreptitious. He added that he doubted the birth of any nation's central bank had ever been so shrouded in concealment. The reason for that secrecy, according to the participants' own later accounts, was primarily political, rather than sinister in the conspiratorial sense. Aldrich and the assembled bankers genuinely believed that if the American public learned Wall Street's leading financiers had personally drafted the blueprint for the nation's new central bank, the entire plan would be dead on arrival, poisoned by justified public suspicion that Wall Street was simply designing a system to serve its own interests. That suspicion, it's worth being honest, was not entirely unfounded. The Aldrich plan that emerged from Jekyll Island was rejected by Congress, specifically because it was seen as giving Wall Street bankers too much direct, centralized control over the new institution. What eventually became the Federal Reserve Act of 1913, signed into law by President Woodrow Wilson on December 23rd of that year, was a substantially revised version of the original Jekyll Island blueprint. It was deliberately restructured by Democratic lawmakers, particularly Virginia Congressman Carter Glass and Senator Robert Owen, to decentralize power away from a single Wall Street-controlled central bank and toward a novel hybrid structure. Authority was spread across 12 regional Federal Reserve banks located in cities throughout the country, overseen by a board in Washington appointed by the president rather than by the bankers themselves. This is the crucial historical nuance almost always lost in either the sanitized textbook version of the story or the more sensationalized conspiracy version. Jekyll Island genuinely happened. It genuinely was secretive, and its plan genuinely was drafted almost entirely by private bankers. But the institution that actually emerged 2.5 years later was substantially modified by elected officials, specifically to reduce, not preserve, the kind of direct Wall Street control the original Jekyll Island architects had initially designed. This history directly explains why the Federal Reserve occupies such a genuinely strange, almost paradoxical structural position within the American government, one that fully justifies the title of this documentary. The Federal Reserve is not technically a single bank at all. It is a system, formally named the Federal Reserve System, composed of 3 interlocking layers of authority. At the top sits the Board of Governors based in Washington, D.C., a genuinely public governmental body whose 7 members are nominated by the President and confirmed by the Senate. They serve staggered 14-year terms specifically designed to insulate them from the immediate pressure of any single election cycle or presidential administration. As of mid-2026, the board is chaired by Kevin Warsh, who was nominated by President Trump and confirmed by the Senate in a narrow, closely contested vote in May of 2026, succeeding Jerome Powell, who chaired the Fed since 2018 and has since remained on as a sitting governor. Beneath the board sit the 12 regional Federal Reserve banks, located in cities including New York, Chicago, San Francisco, and Atlanta. And this is where the institution's structure becomes genuinely unusual by the standards of any typical government agency. These 12 regional banks are not federal agencies in the conventional sense at all. They are structured legally as private corporations, technically owned by the commercial banks operating within their region, which are required by law to hold stock in their local Federal Reserve Bank as a condition of membership in the broader system. This is precisely the source of the second half of this documentary's title. The Federal Reserve isn't fully a bank in the conventional commercial sense, since it doesn't offer accounts to ordinary citizens, and it isn't fully federal in the conventional sense either, since significant pieces of its operational structure are legally private, bank-owned corporations. It occupies a genuinely unique hybrid category that doesn't map cleanly onto either a purely public government agency or a purely private financial institution. Historians and legal scholars have described this structure, without exaggeration, as sui generis, meaning genuinely one of a kind within American governmental architecture. It's worth being precise here about what this private ownership actually means in practice, because it's simultaneously more significant than casual dismissals suggest, and less sinister than the more extreme conspiracy narratives claim. The stock that member banks hold in their regional Federal Reserve Bank is not like ordinary corporate stock traded on a stock exchange. It cannot be sold, traded, or used as loan collateral. It pays a fixed statutory dividend rate rather than a market-driven return, and it comes with no meaningful voting control over the institution's core monetary policy decisions. Those decisions are made not by the regional banks independently, but by the Federal Open Market Committee, a body combining the Washington-based Board of Governors with a rotating group of regional Reserve Bank presidents. The entire system is ultimately answerable to Congress, which created the Fed by statute and retains the constitutional authority to alter or even abolish it entirely through ordinary legislation. Additionally, and this detail rarely makes it into either the textbook or conspiracy version of the story, the Federal Reserve is required by law to return the overwhelming majority of its net earnings directly to the U.S. Treasury every year. Those earnings come primarily from interest collected on the government bonds and securities it holds, and the amount returned has totaled hundreds of billions of dollars over the past 2 decades alone. This single fact substantially undercuts the more extreme claims, sometimes made online, that the Fed operates as a private profit-generating enterprise, siphoning wealth away from ordinary taxpayers and into the pockets of secretive bank owners. The actual, legally documented flow of money runs overwhelmingly in the opposite direction, from the Federal Reserve into the Treasury, not the other way around. What remains genuinely true, and genuinely worth scrutinizing without exaggeration, is that this hybrid public-private structure was deliberately designed from Jekyll Island onward to insulate core monetary policy decisions from direct, day-to-day political control. That design choice carries real and serious trade-offs that remain hotly debated by economists and politicians alike to this very day. So how, exactly, does this hybrid institution wield the almost unimaginable power this documentary opened by describing the ability to move trillions of dollars through the global economy with a single sentence at a press conference? The primary mechanism is something called the federal funds rate, the interest rate at which banks lend reserve balances to one another overnight. The Federal Open Market Committee sets this rate through its regular meetings, and the effects then ripple outward through the entire financial system. It influences the interest rates attached to mortgages, car loans, credit cards, business loans, and government debt across the entire country. And given the dollar's role as the world's dominant reserve currency, those decisions also affect borrowing costs in financial markets across much of the global economy. When the Fed raises this rate, borrowing becomes more expensive everywhere, which tends to cool economic activity and reduce inflation, but also increases the risk of triggering a recession if pushed too aggressively. That was precisely the tension behind the punishing recession-inducing interest rate increases introduced under Chairman Paul Volcker in the early 1980s, discussed at length in an earlier video on this channel covering the economics of the 1970s. When the Fed lowers the rate, borrowing becomes cheaper, encouraging spending and investment, but risking inflation if pushed too far or held too low for too long. Many economists point to that exact dynamic when explaining the cheap money environment of the mid-1920s that helped inflate the speculative bubble preceding the 1929 crash. Beyond simply setting this benchmark rate, the Fed also controls the creation and destruction of money through a tool called open market operations. By buying and selling government securities, it can directly expand or contract the amount of money circulating through the banking system. And during genuine emergencies, as seen dramatically during both the 2008 financial crisis and the 2020 COVID-19 market panic, the Fed can deploy extraordinary emergency powers. It can purchase corporate bonds, provide direct emergency loans to banks and even non-bank financial institutions, and introduce programs designed to keep frozen credit markets functioning. In 2020, it also worked directly alongside BlackRock, the subject of an earlier video on this channel, to help design and execute those emergency bond buying programs. This is the genuinely remarkable, almost unparalleled scope of institutional power described at the beginning of this documentary. A body composed of unelected, though Senate-confirmed officials operating through a hybrid public-private structure originally sketched out in secret aboard a private train car in 1910, is now capable of reshaping the cost of borrowing attached to every mortgage, every business loan, and every government bond in the world's largest economy. Those decisions are announced through scheduled statements that financial markets around the world examine sentence by sentence and word by word for the smallest hint of a change in direction. This concentration of power inevitably invites serious, legitimate scrutiny, and it's worth examining the mainstream debate surrounding the Fed's design honestly, separate from the more exaggerated conspiracy narratives that sometimes attach themselves to the institution online. The strongest argument in favor of the Fed's current independent structure, made consistently by mainstream economists across the political spectrum, is based on the historical record of what happens when monetary policy falls under direct, short-term political control. This channel has covered that pattern before in the story of Weimar Germany's hyperinflation and the currency debasement that helped unravel the Roman economy, where rulers facing immediate political pressure repeatedly chose currency manipulation over harder and more politically costly decisions. Insulating interest rate decisions from the immediate pressure of election cycles, the argument goes, allows a central bank to make necessary but unpopular choices. That includes raising interest rates to fight inflation. A decision that a directly elected body facing voters every 2 or 4 years might be tempted to avoid regardless of the long-term economic cost. The strongest argument against this level of independence made by serious economists and legal scholars from across the political spectrum, including sitting members of Congress from both parties over the years, centers on a fundamental question of democratic accountability. An institution wielding this much influence over the daily economic lives of every American, setting the cost of every mortgage and every small business loan, was never directly elected by anyone. Its leadership is nominated and confirmed through the ordinary presidential appointment process, but then operates with a degree of insulation from continuing political accountability that few comparably powerful bodies in American government enjoy. This tension between insulated technical expertise and democratic accountability is not a fringe concern. It is one of the most seriously studied and actively debated questions in modern political economy, discussed openly in academic journals, congressional hearings, and by Federal Reserve officials themselves. And it has become an especially live and contested issue as of 2026, with President Trump having pushed publicly and forcefully for faster interest rate cuts throughout his ongoing dispute with outgoing Chair Jerome Powell. Incoming Chair Kevin Warsh's confirmation passed the Senate by one of the narrowest margins in the institution's history, reflecting exactly how contested the question of Federal Reserve independence and accountability has become in the current political moment. It's also worth directly and honestly addressing the more extreme claims that circulate about the Federal Reserve online, because separating legitimate criticism from unfounded conspiracy matters enormously if you genuinely want to understand this institution. Claims that the Fed is secretly owned by a small handful of specific foreign or domestic banking families who personally profit from controlling America's money supply are not supported by the institution's publicly documented legal and financial structure. As described earlier, the overwhelming majority of Federal Reserve earnings are required to flow back to the U.S. Treasury rather than to private shareholders. Ultimate monetary policy authority also rests with a Senate-confirmed, presidentially appointed Board of Governors accountable to Congress, not with the regional member banks holding non-tradable dividend-capped stock. What is genuinely and historically true, and doesn't require any exaggeration to be significant, is that the Fed's founding involved a small, secretive group of the era's most powerful private bankers drafting the technical blueprint for America's central banking system. The institution's structure was deliberately designed to sit at a genuinely unusual distance from direct democratic control, and its decisions carry an extraordinary, well-documented degree of influence over the global economy. That influence remains legitimately and actively debated by serious economists, legal scholars, and elected officials today, not as a fringe theory, but as one of the central ongoing questions in American economic governance. So why does a 9-day meeting on a Georgia island more than a century ago still matter so intensely to your own financial life right now in 2026? Because every time the Federal Open Market Committee meets and its decisions ripple outward within minutes into mortgage rates, credit card interest, business loans, and stock prices around the world, you are watching the direct, functioning descendant of the hybrid public-private structure quietly sketched out aboard that private train car under false names in 1910. The structure was designed in the aftermath of J.P. Morgan personally rescuing the American banking system from his private library to ensure that no single financial crisis and no single private individual would ever again hold that much unchecked power over the nation's economy. Whether that specific design, insulated, hybrid, and deliberately distanced from direct political control, remains the right structure for the world's largest economy in 2026 is a genuinely open and actively contested question. It is being fought over right now in Senate confirmation battles, presidential pressure campaigns over interest rate policy, and academic debates about how much democratic accountability a body wielding this much economic power should actually have. What isn't contested, and what the historical record makes genuinely and factually clear, is that the institution controlling the value of the dollar in your pocket was never simply a government agency, and it was never simply a private bank either. It has always been something stranger, something in between, born in secrecy and then reshaped by public suspicion of that very secrecy. More than a century later, it is still quietly shaping nearly every financial decision in your life, one carefully worded press conference at a time. If this story changed the way you think about money, power, and the strange institution sitting quietly behind both, subscribe to Economy Rewind History, because the most powerful players in any economic system are rarely the ones shouting the loudest. They're usually the ones who never had to.